It's interesting. Even with the stock market doing pretty well recently, the long-term earnings expectations have been cut like in half since early 2022.
Wow.
It's a big sign that there's economic uncertainty coming, and it's really kind of shaking up the world of corporate debt.
Yeah.
So we're going to do a deep dive today into why inflation is changing the game for CFOs,
Okay.
especially when it comes to like borrowing money, issuing bonds, and just figuring out their whole credit strategies.
Right. Yeah. It's fascinating how we often think about debt as like this fixed thing on a balance sheet.
Uh-huh.
But it's really dynamic, especially in times like we're seeing now, a lot of volatility.
Yeah.
So CFOs are really having to play this high stakes game of balancing growth ambitions with these threats of inflation and interest rates going up.
So we're talking about like big companies, major corporations navigating this.
Exactly.
What does the current landscape look like for them when it comes to borrowing?
Well, the Federal Reserve has said that uncertainty about U.S. short-term interest rates has gone way up since late 2021
Okay.
to levels we haven't seen in a decade, so really high.
Wow.
And this volatility comes from a few things. Persistent inflation, the responses from monetary policy, like raising interest rates,
Right.
and just this general unease about the future of the economy.
So not a lot of confidence in the market right now.
Right.
But how does that uncertainty actually play out when CFOs are making decisions?
Well, imagine you're a CFO and you've got these big expansion plans.
Right.
You need capital to make that happen, through loans or issuing bonds. But then suddenly borrowing gets more expensive because interest rates are rising. And it can make those expansion plans, financially impossible.
Yeah.
Bond yields are also affected, which makes issuing new bonds less attractive to raise capital.
So it's a tough spot.
And a delicate path.
Let's talk about inflation specifically and its impact on corporate debt. It's not just like a consumer issue, right? Like prices going up at the store.
Right. No, inflation really throws a wrench in the gears of how companies manage their debt.
Yeah.
In fact, the World Economic Forum highlighted a bunch of reasons why this high inflation might be here to stay.
Okay.
Things like deglobalization and trade tensions. And we're still seeing supply chain problems,
Right.
energy prices going up and down,
Yeah.
and then tight labor markets, which means wages are going up.
Makes sense.
All of these things just mean prices are staying high.
So for corporations trying to borrow money in this climate, what does that mean? Does that mean putting those expansion plans on hold?
A lot of companies are doing just that, delaying those plans.
Okay.
It's about prioritizing having cash and being creative in how they can lighten their debt burden.
Okay.
A good example is the leisure and hospitality sector.
Good.
The Federal Reserve did some research showing that industry was really hit hard by the pandemic.
I guess so.
And it forced companies to completely rethink their debt strategies just to survive.
It's not just internal decisions then, right? External forces can just disrupt everything.
It really can.
Which brings to mind two key ideas that I think are important when we talk about corporate debt right now. Interest rate risk and credit ratings.
Yes.
Can you kind of break those down for us in the context of inflation?
Yeah, sure. So interest rate risk basically means, that if interest rates go up, a company's existing debt is going to be harder to manage or refinance. So imagine a company got a loan a few years ago when interest rates were low.
Right.
Now rates are rising, so refinancing that loan is much more expensive and could really strain their cash.
Right.
And then credit ratings are kind of like a company's financial report card. It influences how lenders see them, like how trustworthy they are.
So a good credit rating means you're a good risk.
Exactly. Credit rating agencies look at how financially healthy a company is and give them a rating based on how likely they are to repay debts. A higher rating means less risk for the lender, and that means they get better terms for borrowing.
Okay.
But in times of high inflation, those ratings are even more important.
Because if your credit rating goes down, borrowing becomes more expensive.
Right.
So it's kind of a dangerous cycle.
It can be, yeah. And the Fed has actually been seeing a troubling trend. More and more companies are facing financial distress.
Oh, wow.
More than we've seen in most other times when monetary policy was being tightened. It just shows that these risks aren't just theoretical, they have real consequences for companies that need access to money.
So we've got CFOs dealing with inflation, interest rates rising, and the possibility of bad credit ratings affecting their ability to borrow.
Right.
What are some strategies they can use to manage all this? Debt restructuring comes to mind.
Yeah, debt restructuring is a big one. It's kind of like giving a company with a lot of debt a financial makeover.
Okay.
Refinancing is one way to do that. Swapping out old high-interest debt for new loans with hopefully better terms.
But that gets harder as interest rates go up, right?
It does, yeah.
So what else can they do? Like, could extending the terms of their loans give them some breathing room?
Yeah, extending loan maturities is another strategy.
Okay.
It gives them more time to repay, which can ease the pressure on their short-term cash flow.
Right.
They could also renegotiate covenants. Those are like the rules and restrictions that come with loans.
Okay.
That could give them a bit more flexibility.
So they're looking for any way to make their debt more manageable.
Exactly. Adaptability is key.
Sounds like a lot of scrambling.
It is, and it's interesting because experts are predicting a lot more debt restructuring to happen in 2025.
Oh, really?
Yeah, it's a perfect storm of high inflation, ongoing economic uncertainty, and a bunch of debt coming due all at once.
Wow.
CFOs are going to be busy.
Speaking of challenging environments, where does private credit fit into all of this?
Right.
It seems like that's becoming more popular.
It is. Private credit is becoming a real option, especially for companies that are finding it too hard to borrow in the traditional way.
Right.
Basically, it's a loan from a private lender, not a bank, like maybe an investment firm.
So it's like a back alley loan?
Kind of, but it's totally legal and can be helpful.
Okay.
But I'm guessing private credit has its own challenges, right?
Yeah.
Like higher interest and stricter terms.
Probably.
Yeah, there's definitely a trade-off. Private credit offers more flexibility and faster access to money, which can be really appealing in a tough spot.
Sure.
But it often costs more with higher interest rates and tighter covenants.
So there's pros and cons.
Right. Interestingly, though, even BlackRock, which is a huge investment firm, sees private credit as a possible opportunity during times of inflation,
Okay.
especially for infrastructure projects.
So even with all the uncertainty, there are opportunities out there.
There are, yeah, for those willing to take some risks.
It sounds like CFOs really need to be creative and adaptable to deal with this whole new world of corporate debt.
They really do. This is a time for thinking outside the box, looking at every option and making strategic choices that will help companies get through this and come out stronger on the other side.
Well, you've painted quite a picture. Uncertainty, risk, but also some glimmers of opportunity for those who can adapt.
Yeah.
Makes me think about how this all connects to what the average person experiences with inflation.
Right.
Like, how does that all tie in?
That's a good point, and it actually goes back to those things that drive inflation that we talked about earlier.
Right.
You know, the World Economic Forum talked about tight labor markets and wage pressures as being important factors.
Right, because companies are struggling to find workers, and they have to offer higher salaries and better benefits to compete,
Exactly.
which cuts into their profits and makes managing debt even harder.
It's all connected. Yeah, it's a real domino effect. And we can't forget about how inflation affects consumers psychologically.
Oh, right.
Research from Psychology Today suggests that higher prices actually make us less happy overall. So when people are stressed about money, they tend to cut back on spending.
Yeah.
And that, of course, can hurt businesses.
It's a vicious cycle, isn't it?
It is. Consumers feel the pinch, cut back on spending, that hurts corporate profits, and then it makes it even harder for those companies to manage their debt.
It's all connected.
It is. And here's where things get really interesting. That same Psychology Today article suggests that remote work could actually help slow down wage growth
Okay.
and therefore maybe even help with inflation. Because employees who can work from home might be willing to take a slightly lower salary if it means they get the flexibility and convenience of not having to commute.
So are you saying that encouraging remote work could be a tool for CFOs to manage inflation?
It's an interesting idea, isn't it?
Yeah.
Could be a way for companies to attract and keep good employees while potentially easing some of that wage pressure that feeds into inflation.
Okay.
But of course, it's not a perfect solution.
Right.
Not every job can be done remotely, and there are other things to think about.
So we've talked a lot about the challenges of corporate debt in this environment of inflation.
Right.
Are there any, silver linings here? Any opportunities that come from this?
Oh, absolutely. For investors who know what they're doing, times of economic uncertainty can actually be good for them.
Okay.
We already mentioned private credit, which can have higher returns than traditional debt investments, but of course with higher risk as well.
Right. More risk, more reward. What about those inflation-protected treasury bonds, or TPS?
Right.
Those are supposed to help investors deal with inflation, right?
Yeah, exactly. TPS are designed to protect investors from losing purchasing power because of inflation.
Okay.
Their principal value adjusts with the consumer price index, so even if inflation goes up, your investment keeps up with it.
So even with all this volatility, There are ways to manage. Are there any other investment strategies that you think are worth mentioning?
Well, diversifying your portfolio is always a smart move. That means spreading your investments across different asset classes:
Hmm.
stocks, bonds, real estate, commodities.
Makes sense.
Some experts also recommend looking into alternative investments like gold or other precious metals, which tend to hold their value when inflation is high.
Interesting.
But it's important to remember that all investments come with risks.
Right.
Do your research and make sure you understand what you're getting into.
Good advice. We've covered a lot today, from corporate debt to investment strategies.
We have.
Before we wrap up, let's just kind of take a step back and go over some of the key takeaways from our deep dive into corporate debt and inflation.
Sounds good. So, what have we learned? I think the biggest thing is that inflation is really changing how corporate debt is managed. It's forcing CFOs to make tough decisions about how they finance their operations, where they invest, and how much risk they're willing to take.
We've seen how higher interest rates make borrowing more expensive, which is pushing companies to find ways to lower their debt and focus on having enough cash on hand.
Absolutely.
And we've also seen how companies are adapting by maybe putting off expansion plans, exploring ways to restructure their debt, and even looking into alternative ways to get financing, like private credit. It's a tough environment out there,
It is.
but it seems like those who can think strategically and be flexible are the ones who will do well.
I think that's right. And we also talked about how inflation impacts consumers and how that can affect the economy as a whole. Probably the most interesting part was exploring how remote work could actually play a role in easing some of that inflationary pressure.
It is fascinating how all these pieces connect. It's like this big financial puzzle.
It is.
And it's the CFOs who are trying to solve it in real time with real consequences for their companies.
Exactly. It's high stakes, but it offers some valuable lessons for investors and anyone who wants to understand what's shaping our economy. Speaking of things shaping the economy, I keep thinking about the rise of AI.
Oh, yeah,
It seems like AI could play a big role in all of this.
definitely. We've seen research papers about how AI might affect inflation in both good ways and bad. And sources like Deloitte say that financial institutions are already investing a lot in AI to make things more efficient, assess risk, and make better decisions. Could AI be the answer to navigating this new world of corporate debt?
That's the big question, isn't it? We know that AI can automate tasks, look at huge amounts of data, and spot patterns that humans might miss.
Right.
So could CFOs use those capabilities to manage debt better, predict risks, and come up with solutions we haven't even thought of yet?
Sounds like we've stumbled onto a whole other layer of this puzzle.
We might need another deep dive just to unpack how AI is changing corporate finance.
Exactly. But for now, let's bring it back to our listeners. We've explored some pretty complex topics today, so I'm sure you have a lot to think about.
Yeah, we've been through some pretty complex stuff, but I think it's safe to say we've just scratched the surface.
Right.
And remember, we've been really focusing on corporations, but inflation affects so much more than that. Oh, for sure. Like, think back to when we were talking about consumer behavior.
Right.
The effects of inflation are huge, and they touch almost everything in the economy.
Yeah, definitely.
There's so much more to explore.
And with the global economy always changing, I think it's more important than ever to understand these forces at play.
Yeah, for sure.
It feels like every time we do a deep dive, we end up with even more questions than answers.
That's what makes it so interesting, staying curious, asking what if. That's what keeps us learning.
Yeah.
You never know what you might find out. It's like we're all figuring this out together, this whole economic puzzle.
It's true. And speaking of figuring things out, have we sparked any new ideas for you, dear listener? Maybe you're thinking about your own investments differently, or maybe you're seeing the challenges that businesses are facing in a whole new way.
Yeah, maybe.
We've talked about how tough it is for companies to manage debt with inflation, but we've also shown that there are opportunities out there if you're willing to adapt and be strategic.
Yeah, exactly.
Hopefully this deep dive has given you a good starting point as you navigate this crazy economic world.
I hope so.
We always say knowledge is power. And that's definitely true when it comes to understanding inflation and corporate debt.
For sure.
Whether you're an investor or a business leader or just someone who wants to understand what's happening around them, we hope this deep dive has left you feeling informed and maybe even a bit inspired.
Absolutely. And as we finish up, just remember that this is an ongoing conversation. The global economy is constantly changing, so keep being curious, keep asking questions, and never stop learning.
Well said. Thank you for joining us on this deep dive into the world of corporate debt and inflation. Until next time, keep diving deep and keep learning.